This is the final recording for this subchapter. Remember again, we are at the chapter 3.1 on the third chapter regarding the how to use the Fibonacci tools. In this case, the Fibonacci retracement, and we took a look until now to two interpretations: the standard interpretation based on how to use the Fibonacci retracement regarding the relationships between Elliott waves and the retracements, and the modern view. Under the modern view, there are two approaches. There are two approaches for the Fibonacci retracement to be used. And the first one you've seen earlier, and this is the last one. And the last one that I'm going to show you now, it is based on the second one, but on the fact that the Fibonacci should not be drawn from the absolute high or absolute low. So still looking for confluence areas and resistances or support, but try to go for the next swing. For example, these are also being called the internals of the swing. So the general belief is that in this way spikes are being eliminated out of the range, and the range actually is more valuable in finding confluence zones and areas. One of the great traders in the history of the trading was W.D. Gunn, and he stated, I also wrote this down on the text that comes and accompanies this recording. He stated that he often found that secondary swing away from the actual bottom to be of greater value than the actual price that ends the prior trend. So that means trying to avoid highs and lows when drawing a Fibonacci. I mean, you should have a high and low at the actual top or bottom when you will stop the Fibonacci retracement, but the starting point should be from the next swing. Under the same approach, it is believed that, for example, the only time a trader will have success when using a Fibonacci ratio derived by taking the absolute highs and the absolute lows, like we took the ratio on the first recording of this chapter, is when they are falling, when the 50% line are falling on top of one another. So that is the most likely scenario. Under this approach in here, for example, this is still a euro-dollar chart, but this is a 1 hour chart, or 4 hour chart. Sorry. So again, this is like a recording coming to complete the previous one. So we are looking to find resistance areas. Okay. Yes, resistance with Fibonacci retracement. So to find the resistance level, again, this is a repetition, to find the resistance level above, okay, so above the current market price, you must start with the price low. So you must start with the price low from here on the left. You're looking on the left of your swing, and move your cursor towards the price high, and the resulting subdivision of the market, okay, of the range, must be above the current market price. This was the purpose of the second recording. Under this approach, we are trying to avoid the absolute highs and the absolute low. So when you are starting to apply the Fibonacci retracement, seeing here, trying to avoid all these spikes. So you are not going to start with the low in here, but we are going to start with the next swing, and the next swing is here, and not from the extremes of the swing, but from the real body. Okay. So you start from here, and you go towards the highs, and you want to find important resistance levels. As you can see, resistance levels all over the place in here, at the 38.2, at the 23.6, so on and so forth. Also important under this approach is to try to to try to divide your swing into internal subdivisions. So you may take another Fibonacci retracement, and try to go for the next swing, and the next swing comes from here to here, but not going from the absolute low, okay? But trying to avoid the spike, so you are going from here till the top in here, and this should be your next subdivision. And if you right click on it and change the color, let's make this one blue. What you're looking for confluence area. You're looking for Fibonacci levels that come on top of each other, and that levels normally should be of greater resistance in crossing to the upside. As you can see on this whole structure in here, if you look at the different Fibonacci ratios that you have, okay, the distance between the levels, the smallest it is under the two areas in here. So you might take let's take a shape and derive it from here like this. And we already know that a possible resistance area on a possible move to the upside, it is this one. So this is hard to cross by price when trying to move to the upside. Now this is a Euro-dollar. As you can see, we are still fighting for the 130 level. Presuming we are going to turn, okay, on the move to the, and we are not going to take this low. So this analysis in here, it is right, using the Fibonacci retracement. On the move to the upside, the main important resistance should be still this area. However, it provided once the resistance, so look at this area to be resistance, okay? It was resistance once, and on a second approach to it, maybe a short hesitation, but it should be crossed to the upside, and former resistance turns into support. So if we turn and go to the upside like this, then look for it to provide support for the next move. And then of course we are trying to look for support, and when you are trying to look for support and trying to identify confluence areas using this Fibonacci approach, then you should do it exactly the same, but on the opposite. Okay? Now with this chapter, basically I end my subchapter, my first subchapter, if I might say so, under the comparison between the standard interpretation and model view, how to use the Fibonacci retracement. So this subchapter has actually three different parts for 3 recordings, and on the next subchapter we will take a look at price and time when using Fibonacci. Now I also have a price and time analysis based on the first chapter on the cycle indicators, but you will see that in here it is even more interesting and let's say a little bit new, but interesting to watch. Now I know that many of you consider Fibonacci retracement only from the top and from taking the ratio from the top and to the lows, but under this approach you see 3 recordings with 3 different ways of using the same tool, and I strongly think that this has an important value in the bag of any modern trader. This is a modern approach, a new approach. Not many people know about it. Not many people understand how to use it. So consider it of being, let's say, opening new ways in understanding current markets. Okay. So until next chapter, stay safe on the markets.